So 400,000 basically I should book if I go to my old regime IFRS 4. So this 2 million I will book into my balance sheet as an asset, and I will charge 400,000 every year into P&L. Okay, so that's how I'm deriving 400,000. I still need to do that into my basically accounting software. Okay, but it doesn't appear into my balance sheet and P&L now in that manner. There's no basically deferred acquisition cost into my balance sheet. We just show my P&L part, the release part, okay, into my P&L as amortization of DAC and under insurance revenue.
Okay, but so we are saying that the
Yeah.
remaining 1.6 million we keep it off balance sheet, is it?
Yes, the calculation is still there in the system, but that will be off my financials, right? Still, we will book 2 million into my system will appear as deferred acquisition cost, okay? And still the calculation will happen in same way, but that won't appear in the old way into my balance sheet and P&L. I won't see any DAC into my balance sheet anymore. It is presented into P&L in this way.
Oh, okay. Yeah, okay.
This
I
way,
think I.
yellow lines.
And also on the investment income. Oh, sorry. Jaden, you want to go ahead first?
No, that's okay, Ravina. Please go ahead.
And also on the investment income, that investment income is just a reflect of the finance, the
No,
interest income.
I'll come to that. I'll cover till row 67 only. I will come to that.
Okay, yeah, sure, can.
Yeah.
Right. So, Prashant, one more thing. This row 56 is expected claims and expense. So, in your example, obviously, you took the actual numbers, but in practice, uh, is this expected claim and benefit based on that estimation that the actuaries do?
Not exactly. Basically, this is just whatever we pay as a claim. It's same amount. Okay.
Okay, so
We'll
it's
see one example where my claim is 1 million instead of 2 million. Then how to present that? Okay, that will come into here. Experience adjustment. Okay. So I
so
guess
what you
no. I guess you are
so,
right here. Yes. You're right here. So this is what we estimated. Expected claim adjustment. What we estimated. Yes.
Okay, so this is estimated, and if your estimated is different, then you have an experience adjustment.
Yes.
Yeah, so
If my day one estimate was 2 million, okay, and everything remains same at the end of year when I receive a claim of 2 million, then this is the big picture. If basically I receive a claim of 1 million, then this row 56 will be same, but we will do some that is called experience adjustment. So we
I
will do
understand.
in this row 60.
Experience adjustment, I understand. Your gratuities and all also have that. So okay.
Okay.
Uh, so guys, do you understand what an experience adjustment is?
We will
Essentially,
cover one
whenever
example.
you will cover. Okay, fine.
This is
Glenn,
fourth
I
time
think
we will cover.
Glenn, you also had a question, right?
It's actually more of a comment than a question. So I was just wondering, like, if you could share this, especially with us later on, if there's any break, so that as you go through the examples, we can look at the formulas ourselves. So it's like easier for us to follow through. You see.
Yes, the plan is that I will share this spreadsheet after the session today.
Okay.
That's the plan.
Okay. Yeah. That's
Yeah,
that's fine as well.
share.
Yeah.
I will definitely share all the material as well example will be shared with you through Rupesh.
Okay.
Yeah.
Yeah.
Okay. Maybe for row 68 and 69, I can do a quick change. Maybe I assume it as 4%. Okay. That will make it little more clear. Return on investment, I assume 4%. Okay. Let me quickly change it to 4%. And then basically it will be, yep. Okay. I've changed return on investment to 4% instead of 3. Okay. Now basically here you see row 68 is basically my discount unwinding. Okay, and that comes from basically here discount unwinding on CSM, discount unwinding on my Bell, and discount unwinding on my risk adjustment. Okay, so we need to present it as a expense here. Okay, and similarly, basically my investment income. So at the end of year one, I have earned 4% on my 8 million, right? So that is my 4% of 8 million, 322,000. So it is 20,000. So that's my investment income. And that's my, I get my profit and loss 392.
Okay.
Yep. My balance sheet. So my surplus is coming from my P&L 392. My closing CSM, closing this adjustment, closing Bell, investment will reduce from 8 million to 5.8 million because opening was 8 million, then we paid 2 million of claims and 200,000 of commissions, right? And I take basically investment fair value through P&L here. So my investment value is 6,120,000. Yep, and my balance sheet matches.
Yep.
Any question
Okay.
on this?
I'm fine with this.
Okay, maybe I come to the slide back, which we discussed earlier here. So CSM slide. So it represents the unearned profit of the contract, right? Which we saw in the example. Unlocked for change in the fuel fulfillment cash flow related to future services. So this we will cover in next example where my estimate changes. Okay, CSM cannot be negative but can be reinstated. Again, this we will cover in our next example where this was a profitable contract. Okay, if my contract is loss making, how to do that? So if my contract is loss making, then I cannot have a negative CSM. It has to be zero. Okay, we will discuss that as well in our onerous section where we will discuss onerous contract, how to account for that. Okay, previous losses have to be reversed before reinstating the CSM. Again, we will cover it at the onerous contract point of view. For example, there is no CSM in the beginning. We have flowed it to zero. Then if the estimate change and the contract become profitable, how to reinstate the CSM? We will discuss that. CSM is released over coverage period based upon the coverage unit. So again, we saw that my coverage unit was 5 there because it was 5-year contract. It was assumption flat 5. Okay, so we saw that we release of CSM based upon the coverage unit. Again, in the next slide, we will see some example how to determine the coverage unit.